and welcome to One-to-One Mining Investment APAC Online. Today we have Angela Durant, Senior Research Manager at Wood Mackenzie, here to talk about the outlook for nickel.
I'd just like to thank the One-to-One team and Amy Rotman for inviting me back to speak at the Asia-Pac conference this year. It's certainly different presenting to you all from a distance, but I'd like to thank you for taking the time to listen to our latest nickel market outlook, which is titled Near-Term Nickel Prices Defy the Fundamentals, but is there an alternative to structural oversupply? When I presented at One-to-One's conference in Sydney in November, I started with the nickel price chart, and this year I'm going to do the same. We can see on the blue line in the chart that up until March or mid-March, we saw nickel prices falling. After originally expecting annual averages for 2020 to remain roughly unchanged compared with 2019 at around $13,903 per tonne nickel, we revised our annual prices down to $12,068 per tonne nickel. But to our surprise, and no doubt the rest of the world's, since early April, prices have steadily climbed, peaking at $15,658 per tonne on September the 2nd. Indeed, our annual average for 2020 is now edging back closer to the 2019 number. As the chart on the left-hand side illustrates, it is not only nickel that has actually experienced this rise in prices this year. In fact, all LME industrial metals prices started increasing once Wuhan, which was at the center of the coronavirus epidemic, ended its lockdown on April 7th. And subsequently declared itself virus-free only 3 weeks later. With the Chinese Spring and New Year holidays of late January and the pandemic seemingly well behind them, we all started watching for signs of industrial recovery, which was assisted by the Chinese government's stimulus injection of around $506 billion in early May. The declining value of the US dollar versus the other currencies has also supported elevated base metals prices. In contrast to China's emerging recovery, the rest of the world's response to the virus can be described as varied and hesitant in many cases. And we believe that this mixed approach helped to extend the climate of doubt and fear across the globe, which in turn provided the foundation for steep increases in the safe houses of gold and silver. And we can see that gold and silver prices have increased rapidly over that same time period, as can be seen in the chart on the right-hand side of the slide. So while the price movement across the LME metal suite has been largely positive, we need to understand why the fundamentals, that is supply and demand, are, in our view, not driving this upward momentum, especially in nickel prices. If we look at the chart on the bottom left-hand side of the slide, we are now looking at large consecutive surpluses in the nickel market for the next 5 to 7 years. Why has this occurred? Well, since the beginning of March, we have made sweeping cuts to our demand forecast because of the increasingly severe impact of the COVID-19 pandemic on the global economy. And this has moved the market into greater surplus. Not aiding the situation is the fact that the supply is still increasing. The ongoing ramp up of massive nickel pig iron capacity in Indonesia, particularly at Tsingshan's Morowali operation, has made our projected surpluses even larger. We currently calculate our cumulative excess, which is shown in the red circle on the bottom chart, to be around 1.2 million tonnes over 2020 through to 2025, or the next 5 years. In addition, stocks are also on the rise, as shown in the top chart. And we expect nickel stock days will actually surpass their previous 2015 peak of 293 days by 2024. And this is not likely to come down before the late 2020s. And lastly, the strength in prices has meant that producers are currently under no pressure to cut output. And so production is continuing on as normal in most operations. So while deficits now seem a long way off, in 2028 and 2030, today I want to go into more detail as to why the nickel market will be oversupplied for so long. And then I want to make some suggestions as to why this rather depressing view could change. So given the fundamentals, our current view of prices through to 2025 is largely negative, and this is based on our base case scenario of seeing 8 straight years of markets being in oversupply. Even in nickel, history does not tend to acknowledge the long-term relationship between supply-demand fundamentals and price trends. So between 2007 and 2015, prices fell as stocks increased. And while the reverse was true, as you would expect, between 2015 and 2019. But there are some short periods of exception to this general rule, such as back here in 2006 and 7, shown by the red circle above in the top chart on the left-hand side. When stocks rose, prices also rose. But then we saw really strong demand growth in China. We still think we are passing through one of those times of exception now. Once again, entirely due to strong growth in China and the country's relatively new partner, Indonesia. And this can be seen in the chart on the bottom right-hand side. Despite the mid to long-term negative view on prices for the remainder of 2020, we still expect to see a rising trend. This is largely based on the idea that a China-led recovery will help to absorb some of the current surpluses. This year, as China's recovery seemed to gather momentum, nickel prices began to rally really from early May. In our April monthly report, we presented global metal market surpluses on a quarterly basis, shown here in the chart, which did not, on the whole, inspire the idea that there would be a nickel price rally, let alone one that would be long-lasting. Even our balances, as they stand today, are not materially different in the anticipated trend of excess. But it is the distribution of the excess which has given life to nickel prices, with the worst of the surplus falling in the shutdown-afflicted first quarter in China rather than the second. With an anticipated third quarter imbalance and Chinese demand still rising, some conditions were coming into place for price makers to reject both the gloom of the recent past as well as the surpluses going forward. The focus for nickel had returned to the day-to-day improvement in China and Indonesia. So what was going on in these countries to inspire such renewed optimism? Well, in China, we were able to see the full extent of the surge in total stainless melt production for the second quarter by late July. And to work up a best guess calculation for nickel contained in stainless by August. Our April forecast for Q2 of 6.6 million tonnes already represented an 8.3% increase on the holiday and virus hit first quarter. And we thought back then that this was quite a bold prediction to make, given the prevailing uncertainties. Now, the output figure for Q2 of 7.35 million tonnes is a near 22% increase on Q1. And this puts that boldness into the shade. Furthermore, the proportion of nickel-containing 300 series product increased even more by 26% on the first quarter, which is shown in the chart here on the right-hand side. So what did this surge in Chinese 300 stainless melted production do for our primary nickel demand? Well, effectively, we calculate that nickel demand in stainless in China rose by around 50 kilotons in the second quarter alone, compared to Q1. Just to put this into context, that single quarter-on-quarter increment exceeds the annual requirement of nickel in stainless demand by all other leading countries in their respective regions. Furthermore, if our data for China holds, as you see now, it means that Chinese nickel demand for stainless for the third quarter alone, which will be a new high, by the way, of 304 kilotons, is 10 times that. Is 10 times what the US or Indian stainless sector will consume for the whole of 2020. You could say that we have reached the stage whereby what happens outside China and now Indonesia is almost irrelevant to nickel prices, or at least it has been since April this year. In fact, from a demand point of view, countries other than China have been exhibiting low growth or even outright contraction for over a decade already. For nickel producers in the West, or at least for some of them, producing the right types of nickel products the influence on nickel demand from the electric vehicle and energy storage revolution really cannot come soon enough. And to talk briefly to our view on battery materials, which will be covered in much more detail by my colleague Gavin Montgomery as part of this one-to-one series, I would simply like to highlight that the real demand for nickel in batteries is expected to kick off from 2025, as can be seen in the blue bars in the chart on the right-hand side of this slide. At the moment, batteries remain a small market for nickel, but this changes post-2025. For now, stainless remains the main first user of nickel, although its share falls to less than 50% by 2040 as battery precursors for electric vehicles and energy storage become increasingly more important. But meanwhile, getting back to our story and the situation that faces the market now, despite the obvious advances in stainless steel production that we have seen in China, we do not think that the country will stop there. Just last month, we saw the latest move in terms of the sector's consolidation, which brought two state-owned enterprises under one umbrella. Bao Steel, itself the result of a merger between Bao Steel and Wuhan, and subsequently expanded by taking control of Desheng Stainless, is now also going to take control of Taiwan Iron and Steel, basically TISCO, and push the group's stainless melt capacity up to between 7 to 7.5 million tonnes per annum. An expansion plan at Desheng could also increase this to 10 to 11 million tonnes by the end of the period under discussion here, which is 2025, allowing the new Bao Group to challenge Tsingshan's leading position. Beyond this move, we note that there are always more projects coming up, which will keep the global spotlight on China where stainless is concerned. And when Chinese companies aren't investing at home, they can be frequently found looking for new ventures in Indonesia. Tsingshan Indonesia, which was the first company melt stainless here, was joined by DeLong this year. And this additional requirement for nickel units was another contributing factor to the noise about Chinese demand for nickel rising during the second half of 2020. After a slow start in the first quarter, DeLong Obsidian's mill in Conway ramped up in Q2, producing at its nominal capacity rate of 50 kilotons a month, or 600 kilotons on an annual basis. Since July, however, output has increased by 20% to 60 kilotons a month. All output at Obsidian is stainless billet, which DeLong is shipping back to China for processing on its recently installed long product lines. As stainless billet, it is exempt from anti-dumping duties that are otherwise on slab and other flat product semis going into China and many other countries around the world, which has been more of a problem for Tsingshan's global expansionist ambitions. Aside from the growth in stainless melt, however, this slide and the one before to a certain degree illustrate how Indonesia has become China's source of low-cost nickel units for its own melt shops. For the best part of this decade, the government of Indonesia has prioritised its policies to upgrade ore for export into processed NPI for export, and Chinese capital has made this a reality. The surge in total Indonesian NPI production capacity will ensure sufficient feed for domestic stainless melting as more furnaces are added, as well as to combat the decline in NPI production in China itself. The increasing dominance of China can be seen in the charts above, with the red bars highlighting how quickly NPI capacity has increased since Tsingshan first started operating at Morowali in 2015. It is certainly not a surprise that China is choosing to make nickel pig iron in Indonesia rather than import the ore from the Philippines or elsewhere. From a production cost point of view, as shown here, and by the cost curve and the cost breakdowns, the efficiencies to be gained, especially from operating within an industrial park, cannot be beaten. With low costs for ore transport, electrical energy for smelting, and subsequent shipment of a product tailor-made to stainless. Indonesia's EAFs and RKEFs are making the older blast furnaces in China look comparatively high cost, and one would ask if Chinese located blast furnaces actually have a future. As we have seen, Indonesia has become both a stainless steel powerhouse and a Class 2 nickel pig iron supplier to China as well. The fact that there is more on the way in the form of nickel pig iron projects is not surprising. We see about 40 kilotons contained nickel in new nickel pig iron operations coming on stream next year in 2021, rising to around 200 kilotons by 2025. And while this will be good for the Chinese stainless steel investments in both Indonesia and China, it does contribute to the excess of global nickel units that we will see over the next decade. So let me bring you back to the supply-demand balance I showed earlier, which outlined the near decade of nickel surpluses that we currently see ahead of us. Some of the surplus does come about as a result of timing between the nickel pig iron operations currently ramping up or new projects coming online, and the ability of the stainless steel plants in China and Indonesia to absorb all of this material. Even in this chart in the middle, we can see that China shows a nickel unit surplus of around 45 kilotons this year, but in a total domestic market of around 1.4 million tonnes, of which 80% even today is accounted for by rising stainless steel portion, we are not so concerned about 45 kilotons of nickel excess. Looking forward, what options does China have, even if it wanted to reduce that nickel excess on average? Well, in our view, there are several. China can obviously increase stainless melted output beyond the average 4% per year that we currently show from 2019 through to 2025, specifically the nickel containing austenitic proportion, which we expect will run a little lower at around 3.5% on average. More stainless melt shop expansions or greenfield plants have said they will target non-nickel containing ferritics, so 400 series effectively. But we have already seen this year that these proportions can change. Perhaps the easier way, though, is to use higher volumes of NPI coming forward as a replacement for that scrap. We have seen in prior years that this relationship works. Chinese scrap ratios were above 40% at times before the advent of NPI, then dropped to an average of 18% between 2011 and 2016 as NPI became more available. Given its cost effectiveness, NPI will be used as preference to scrap. And if more NPI becomes available ahead of the new stainless melt shops, then another period of lower scrap ratios would come into view. Taking this 18% ratio rather than the 20 to 25% range we currently show would result in a net gain of primary nickel consumption in stainless of between 50 to 120 kilotons per annum. We have already seen that the low contribution of nickel demand growth of 1% per annum that will come from the rest of the world to 2025, as it awaits for electrification to kickstart demand. For the China-Indonesia growth pole, stainless steel and NPI developments will shape their world and will have an important influence on prices globally. And China's influence on prices will be over the long term as well as the near term, as LME and SHFE prices have shown this year. Strong imports of traditional ferronickel and NPI by China during the first half were made in the knowledge that nickel ore imports would be lower, especially from Indonesia. This we expected, but on top of that, we have seen some withholding of NPI by companies for their own use during the second half, which they would ordinarily sell to third-party stainless melters. Consequently, NPI values have increased by more than 13% since early August. As the spot market availability tightens, while ferronickel discounts to LME firmed from US dollars $1,900 per tonne in Q1 to $1,200 in early Q3. Equally, ore prices into China have increased by 30% over the past month, with yet no sign of slowing down. These are the near-term prompts that are giving prices the boost that we have seen on world markets. despite the well-known and widely expected global surpluses for this year and for the midterm outlook. We believe that this price surge will actually correct itself by mid-2021, with the current set of circumstances that are providing price support evaporating as the Chinese NPI and stainless sectors smooth out their imbalances. But for now, what China and Indonesia are doing is setting the tone and direction for nickel prices in this otherwise pandemic-ridden world. And I think with that, I'll sign off